Hi all, this is Yashwant, and in this video we are going to be looking at mutual funds and its types. So basically, what are mutual funds? Mutual funds is a place where people put together their money in which the fund managers use that money to buy stocks, bonds and other securities. So basically, mutual funds are of two major types and the second type is of one other type. So they're actually actively managed funds and passively managed funds. And the passively managed funds, which we talk about, actually has a type known as index funds. They both are very similar, but still they have slight differences. So let's talk about them in this video. So first of all, starting with actively managed funds, I actually have a list of things which I have to speak, because in these financial videos I just write all those subheadings which I have to cover, because I don't really miss anything or I really don't add up something which is not seriously important here. So I just have a list of subheadings for me to remember everything. So first of all, we have actively managed fund. Actively managed funds are mutual funds which are invested by the fund manager, and they're basically analyzed by the fund manager and they look closely at the investment option before they invest. This is the work of the fund manager, and the basic scope of actively managed funds are basically to beat the average market returns. They actually want to obtain more returns than the average market returns. So that is their use. But when it comes to the disadvantages of actively managed funds, their expense ratio and their cost price is too high, because they have to give salary and they have to own a research team to run this, because the researchers of this team do analysis of the investment options. So this is very important. So the second subheading which we have here is passively managed funds. So passively managed funds, so okay guys, write the definitions which I'm going to be telling you guys now, because it's very important. Passively managed funds are funds which are used to mirror the index. Yeah, passively managed funds are funds which are used to mirror the index, which means that the securities in the passively managed funds are as same as in the index. So the investment which is being done in these passively managed funds does not need any analysis, and their scope is not to beat the average market returns, or their scope is not to beat any the market. They just want to reflect the benchmark index. Remember this keyword, they do not want to beat the market, but they want to reflect the benchmark index. This is very important. And their biggest advantage in this thing is that they have a very less expense ratio and a cost price, because that is seriously important, because the cost price is as low as 0.05 percentage. And for example, if you invest 100 rupees in passively managed funds, the 0.05 percentage of 100 rupees is basically just 0.5 paisa. Yeah, I mean that 5 paisa for every 100 rupees. This is the thing. But when it comes to actively managed fund, it takes you a lot of money to rent a group of researchers and make researches. And one disadvantage about these actively managed funds is that their use is to beat the average market returns. So these actively managed funds do really worse than the average market returns. Yeah, their return level is less than the average market returns. So it totally goes vain when you invest your money for you do stock investment. This is a very important point, guys. It's ways to do stock investment in actively managed funds, but it's super useful when you do bond investment in actively managed fund. This is a very important point. So coming back to our topic, passively managed fund, your fees which you have to pay for every 100 rupees can be as low as 5 paisa, And another point is that passively managed funds can also be called as index funds. So I'm going to be telling you all the definition from the notes or the subheadings and the notes which I have here. I'm going to be telling you all the definition of index funds. An index fund is a mutual fund whose portfolio is built to match the constituents of a stock market index. In simple terms, each index fund is based upon the stock market index. It actually buys all the stocks in the same proportion. It does not want to buy stocks in one in higher proportion and another in lower proportion. And the index fund tracks that if there is some change in the portfolio and if there's a very minute change in the portfolio as well, there's a change in the index fund. This is the work of index fund, and the index fund tracks the portfolio very closely. Yeah, very closely. So I hope you all understood the concept of index fund, passively managed funds, actively managed funds, and mutual funds. I hope you all understood these concepts. I'll meet you all tomorrow in a new video. And then tata bye, see you all. Bye bye, see you later. Bye. It's Yashwant, your digital trainer, signing off. And this is Finance for Kids and Beginners Part 6. And I've did 4 concepts in the same video. That's why I have a notes. Usually I don't have such notes to see the subheadings, but when it comes to this kind of long video, I want to know what all are the subheadings which I want to cover, because I seriously don't want to miss any important points which would cause a disturbance in your knowledge. So okay guys, don't forget that finance is your friend. Bye. See you later.